Hi everyone, welcome back to my channel, Accounting with Common Sense. This is your friend Junaid. This video is a continuation of our previous video about balance sheet. So if you want to know how did we manage to get these numbers, I would highly recommend you to go back to that video and please check it out. Now, in this video, in the previous video, I noticed that I did write here long-term liability. However, I did not put any long-term liability here. So before we jump on to into seeing that now that business has the inventory and have obviously placed to do the business, when it went on to selling, how did it go and how did then a profit and loss account look like? Before that, let's just quickly, since that we have long-term liability here, let's just do one entry here as well. Let's assume that the government had this policy, or the banks had simply got this policy, to offer loan for, let's say, 15-20,000 worth of euros to all the new starters, and bank approached the owner, and owner just simply went on and took a loan for, let's assume, 15,000 euros. Okay, so in that case, obviously after, the minute 15,000 came into the bank, 15,000 came into the bank, we are now thinking to obviously record a liability, right? But we are not sure, are we going to put it into current liability or are we going to put it into long-term liability? Without going into too much details, let's assume if this bank loan was going to be paid within a year, we would put here. We would record the 15,000 here. If it is more than 1 year, then 3 years, 5 years, 10 years, or whatever, then we would obviously record it here, okay, for the starter. Normally what happens is, normally what you do is the amount of loan that is due within 1 year, you kind of put it here and the remainder goes into this. We are not going to go into too much detail. Let's just straight away put the loan amount into long-term liability. We will, after these videos, we will come up to those videos where we'll be discussing the advanced entries and as far as balance sheet is concerned, profit and loss is concerned, and statement of cash flow is concerned. So yeah, let's just put that 15,000 worth of loan that came into the bank in our long-term liability, while assuming that it was going to be paid within 3 years, right? So bank loan, we created a long-term liability for us for 15,000 euros. Okay, right. So now let's go and start selling. Okay, so inventory 20,000 here. Let's presume in the month of December 10,000 worth of inventory was sold. So we are going to then get rid of this 10,000 from our balance sheet simply because it has been sold. So we reduced it down from here. Where it is going then, we have to obviously put it somewhere. So this 10,000 worth of inventory that we literally just sold or cleared from our balance sheet, it would go on and become cost of goods sold in the P&L. Okay, and let's say this 10,000 worth of inventory that we sold it for 20,000 euros, right? Since we sold it for 20,000 came into our bank. Yeah, so let's just increase our bank as well. Okay, so we sold items for 20,000, we bought them for 10,000, and that's our gross profit. Let's assume that during the month we incurred some other expenses as well, and those expenses are these which you could see in front of you. Let's say on cleaning, the business spent 200 euros, on repairs maybe 350, right? On miscellaneous, I don't know, 270. Salary, the owner gave himself a salary of 1,000 euros, for example. Business needed to be promoted on a social media, so the owner spent let's say 400 euros on Google ads or Facebook ads or stuff like that. So that's basically it, right? Now that during the month these expenses happened for 22.20 euros, and they were paid by the through bank, right? So let's go and reduce bank by 2220, right? Okay, and then this profit at the end of the day it's a owner's profit, right? The business profit. So it has to go somewhere here in the owner's equity section. Okay. This profit, for a moment, let's just call them retained earnings. We will later on, as I mentioned to you earlier, we'll later on these things. We will learn later on, in our later videos about these things in a bit more detail. But for now, let's just, because I already put the formula there, sorry. Let's just put that, this profit here. So this is basically it. Our balance sheet at the end of the day is balanced, and we saw that how things went on in the first month for this business. What were the sales, how much worth of stock we sold, what were the other expenses that were incurred, obviously what's the profit. Now I'm going to stop the video right here, but before I do that, I want to tell you this, that there is a way to analyze these as well. Okay. If you are an accountant, or if you're a CFO, for example, or a financial controller or whatever, the minute you're going to create your management accounts, or let's say whenever you're going to do these financial statements for yourself, there is a way to analyze these. Okay. And I'm telling you this, that those big boys, they are very much experienced, and they could literally tell you by the way this balance sheet would look like, or by the way the profit and loss would look like, that is it good, bad, are we doing good, are we doing bad, or basically the whole bunch of analysis. So that analysis as well we'll be covering in our coming videos. But for now, this is pretty much it, and I hope you guys have now got a good idea. My next video I'll be preparing up for debits and credits, and then obviously T accounts and trial balances after that. Once all of this exercise is done, I would then take you guys to a bit nicer journey where we would be looking at some complex entries, and it will be a super fun thing. Okay, until that, guys, until that time, look, just take a very good care of yourself, and I will talk to you. Bye-bye.